am Jeremiah Ajuda-Dusu, the author of JAD's Business and Financial Accounting. Hi, good to see you today. Okay, and how was your weekend and how's your day going? If you're following us. All right, let's not waste time, okay? Let's not waste time. So, we've been on group balance sheet, or we call consolidated balance sheet, okay? So, in the previous classes, we've been able to talk about, full ownership. That's 100% control. That is where a particular business or a particular organization has 100% control of another organization. And then we also looked at the scenario where a particular organization has control of the other organization, but it's less than 100%. So in that case, there's minority interest. Because we said, if for instance, if A Limited has 80%, then the other 20% is called minority interest. But then in the previous scenarios, we've been able to look at scenarios where the acquisition date is the same thing with the date of consolidation. So today we are looking at, of course, we're still on group balance sheet, but in this case we're looking at pre-acquisition reserves, and then we're looking at the post-acquisition reserve. So in a nutshell, what this means is that the date of acquisition, okay, it's not the same thing with date of consolidation. So what we're saying is that the date that the business is acquired by the holding company, of course, you know what the holding company is, or the parent company, the date that the business is acquired by the parent company is not the same date that we're consolidating. So, of course, we're still using A Limited. This is the parent company, or you can call it the holding company, right? So we're saying that A Limited acquires B Limited. B Limited is the what? Subsidiary, okay? So if A Limited acquires B Limited, but the date that A Limited is acquiring B Limited is not the same date that we're preparing the consolidated balance sheet, okay? Or the group balance sheet. So when you have that scenario, you're going to have pre-acquisition reserves and post-acquisition reserves, or what I call pre-acquisition values or post-acquisition values. But then we're paying attention to what? To reserves here. So what I'm saying here is this. So let's say, for instance, say A Limited acquired B Limited, okay? Let's say on 31st December 2016, when B Limited's reserve, let's say it was 10 naira, okay? So, as at the time A Limited acquired B Limited, the reserve of B Limited was 10 naira. Now, as at the time we're preparing the consolidated balance sheet, let's say that as at the time we're preparing the consolidated balance sheet, B Limited has 100 naira reserve. So what we're saying is that as at when we acquired B Limited, as at when A Limited acquired B Limited, the reserve was 10 naira. But as at when we were trying to consolidate, B Limited has 100 naira as reserve. So what this means is that the reserve for the purpose of consolidated balance sheet, of course, is 100 naira, but it's going to be pre and what? And post. For pre, are you there? You're going to have the 10 naira. Then for post, you're going to have 90 naira. So apparently, when you add up the two, you have 100 naira. So the reserve, okay, as at the date of acquisition, or reserves accumulated before the date of acquisition, okay, is what we refer to as pre-acquisition reserve. That's reserve before acquisition. Then any other reserve subsequent, okay, toward date of what? Acquisition, or after acquisition, is what we call post-acquisition what? Reserve. Now, for the sake of consolidated what? Balance sheet, it's also possible to have, of course, your minority interest. Now, when minority interest is in, it means that what? The holding company does not have 100% ownership of all the what? Reserve. So in that case, we're not saying that because of minority interest, there is a way that we are going to what? Apportion the reserve into pre and what? Post. So now taking this example, now let's say that what? A Limited acquired B Limited. Now let's say A Limited has what? 90% in what? B Limited. A Limited has 90% in B Limited. It means that what? The parent company or the holding company has 90%. Then the subsidiary has what? 10%. So what this means here is that what? This reserve, okay, of course, is 100. Now, we're going to say reserve, which is 100 naira, okay? Now, of course, you have pre, and then you have post, okay? Now, for the purpose of consolidated balance sheet, this 90 naira here, for consolidated balance sheet, we're going to have 90% of what? The holding company, okay? So that means the holding company will take 90% of this, which is what? 0.9 times 9, that's what? 81 naira. Okay, that will be post. Then for pre, which is 10 naira, the holding company will take 90% of 10 naira. So 90% of 10 naira will be what? 9 naira. Minority interest, we take it full 10% of the 100 naira. So 10% of 100 naira is what? 10 naira. So if you add up 9 plus 81, that's 90. 90, if you add these three, you're going to end up having what? 100. So because of the minority interest in it, okay, the what? Reserve after acquisition, the holding company takes its percentage. The reserve before acquisition, the holding company takes its percentage. And then the minority interest take its own what? Share of the whole reserve. Of course, you know, if we explain it simply, we're just saying that before you invest, before you are, of course, acquisition will be in form of investment. There's a reserve that the business has been building before you came to invest. So in that case, it simply means that there's an amount or there's a reserve that your investment has not worked for, and there's a reserve that your investment has worked for. So the investment that your reserve has worked for will be the investment after acquisition. But the one that you have not worked for, which you just came in and you bought into, okay? You know, just like the issue of premium and issue of shares, okay? You know, you bought into it. So for you to now buy something that's already been existing, you have to what? To pay some premium. Okay, that's sort of arrangement. So here we're just saying that what? There's a reserve that your investment has not. So you're buying into it. That is pre-acquisition. That's before acquisition there was a reserve, and after acquisition there was what? A reserve. So we're trying to separate the reserve before acquisition and the reserve afterwards acquisition. Then, but for the purpose of minority interest, okay, so when you take out the minority interest, it's a reduction. So we say that what? The reserve after acquisition, the holding company takes its percentage. Then the reserve before acquisition, the holding company takes its percentage. When you add the holding company's percentage of the reserve before acquisition and reserve after acquisition, with the minority interest is what? Share of the reserve. You're going to have the total reserve in the what? Balance sheet of the what? Subsidiaries perspective. Of course, that will now help us to compute our goodwill, which we will now use to compute what? The consolidated what? Balance sheet. So let's look at something very simple here. Let's, as usual, of course, we're going to say A Limited, which is the holding company. So let's say these are our assets, right? So we'll say investment in B Limited, right? As usual. So let's say this is 200. Then let's say property, plant, and equipment. Of course, let's say this is 250. So this is 450. So let's say our liabilities now. This is holding company, A Limited balance sheet. Okay. Let's say reserve here. Let's say 100. Okay. Then let's say share capital is, or let's say reserve is 150. Okay. Let's say reserve is 150. And then share capital here, let's say is 300. So everything is what? 40. So this is the perspective of the what? Holding company, right? This is the holding company's perspective. Okay. So let's see the subsidiaries perspective. Let's say this is B Limited, right? Of course, you have assets here. Say property, plants, and equipment. Let's say 200, right? 200. Then these are our liabilities. Let's say reserve 100. Share capital 100. Everything is what? 200. So let's prepare the consolidated what? Balance sheet. We already explained that here you have the holding company have 90%, so that has 10%. So that's what we're looking at now. Holding company has 90%, subsidiary has 10%. So let's do what we know how to do. Of course, we are saying here that the date of acquisition, okay, is not the same thing. Okay, so let's say this guy acquired A Limited acquired B Limited in a date before what? The date of the balance sheet. Okay, so let's say this is as at 2018, as at 2018. Let's now say that what? Let's say, okay, A Limited acquired B Limited in 2016 when B Limited's reserve, okay, was 10 naira. So we're looking at it this way now. So of course you can see that the reserve is 100. This is 100. Pre is 10, post is 90. But there is minority interest of what? 10%. So don't forget that. So it will now mean that, let's go now. We have what? Investment. Don't forget your asset, liability, expense, and income. This is debit, this is credit, this is debit, this is what? Credit, right? So this is investment. So balance brought forward from the perspective here is 200. Okay? We have revenue that is 200, right? What's the next one here? We have share capital, right? Share capital for what? For B. Okay? What's B share? 100. So we have balance brought forward. What do you have here? 100. Of course, sorry, excuse me, it's credits. Don't forget that. 100, right? So now, holding on has 90%. 90% of 100, okay, is 90 naira. So we say what? Investment. We have 90. So we have B limited is 90. So minority interest, then we take 10 naira. That closes the share capital. So let's look at the reserve now. Let's look at the reserve. Credit. So this is balance brought forward, right? And what do you have? 100. Remember I told you, right? For the pre, you see this now? For the pre, this pre here is what will come to investment. That will be 90%, 0.9 of this, which is 9 naira. Okay? So we say what? Investment, 9 naira. This one here, are you there? So we say reserve, 9 naira. Okay? That's what you have there. So you have 19 naira from the share capital. You have 9 naira from the what? Reserve. Okay? That's for the pre. Okay? Then we now have what? Minority interest. Minority interest. The minority interest is 10% of this. That's what? 10 naira. So minority says what? 10 naira. Okay? That will go to minority interest there. Then we now have what? 90% of this. Okay, 0.9 times 90, that's 81. So if you add all this, that will give you 100. So this will go to what we call the consolidated reserve. To be added to what? The holding company's what? Reserve. Okay? So of course, that will be the difference here. So the difference here will be consolidated what? Reserve, which is 100 minus 19. I think that's 81. So we have 100. So this can wipe off now. We have 100. Okay? So what do we have now? We have investment, we have 200. We have from the share capital, we have 90. From the reserve, we have what? 90. That's 9. Okay, so let's go. What are minority interests? Minority interest here. From here, we have share capital. How much share capital from here? 10 naira. Right? Then from reserve too, we have what? 10 naira. So that means our minority interest about 20. Carry down here for 20. So we have brought down about 20. Okay? So what next? Then we have this consolidated reserve. That will be added to what? This 150. So if you're having your this one now, 200 minus what? 99. Okay? So we have 200 minus 99. 10 minus 1 is 1. 10 minus 1 is 1. What do you have? 10 minus, no, 10 minus, this is 0. 10 minus 9 is 1. 9 minus 0, this is 101. So we have our goodwill here, 101. So everything will be what? 200. Everything will be what? 200. Right? So our goodwill debit balance. Goodwill debit balance now will be what? So we have our investment, it will be what? 101. So this will appear in the what? Consolidated what? Balance sheet. Then our reserve here, which is 150, we added to 81 here. So we have 150 plus 81. So what do we have? Consolidated reserve. Balance brought forward 150. That's for the holding company. Then we now have what? Subs reserve, right? What do you have? Or let's call it post-acquisition reserve. What do you have? 81. So this will be 0, 8 plus 5. I think that's 13. Yeah, 3 is 1, 231. So 5 down is 231. 231. Draw down is 231. So with this now, we are going to do the subsidiaries, the group balance sheet. So you can see that what the investment has cancelled out here. Right? Share capital has cancelled, reserve has cancelled. So what do we do now? Let's prepare the consolidated balance sheet, right? So what do we say? We say what? A Limited and its subsidiary. Okay? So we have our what? Asset, property, plant and equipment. What do we have? 200 plus 200. No, 250 rather. What do we have? 450. Right? So we have 450. This product is what? From the subsidiary 200, holding on to 250, that's 450. And what are our liabilities now? What are our liabilities now? We have our what? Reserve. Our reserve is going to be the new reserve here. What's the reserve here? 231. Don't forget there's goodwill. You know what I'm doing. So we have 231. Then we have the share capital here. Share capital is what? 300. So we have 531. Now, what's our investment here? 101. So that means that what? Our assets still has what? Goodwill. Goodwill here is having 101. So we have 101. So if you add up, we have 1555. 2000 is 551. Now, reserve here is 231. Share capital is 300. Then what are minority interest? 20. So we have minority interest, which is what? 20. We add up here. This is 1, this is 5, this is 5. So you can see that your total asset is 551. The total liability is 551. So what we have done here is to consolidate by taking into consideration pre-acquisition reserves and post-acquisition reserves. So what I said here is that what? Your pre-acquisition reserve is what forms part of what computing your goodwill. Your post-acquisition reserve increases the what? The holding company what? Reserve position. So by so doing, we're going to look at the reserve before acquisition and the reserve what as at the balance sheet date. So the reserve before acquisition is the pre-acquisition reserve. The holding company takes its percentage, which is what we have done here. Reserve before acquisition is what? 10 naira. So holding company is 90%. So 90% of 10 naira is 9 naira. That is what we brought here. Minority interest will take its what? Full share, because it's been there all the while. So 10% of 100 naira is 10 naira. Okay? So you can take the balance, but then you can as well still compete by saying post, of course, is 90 naira, but the consolidated the holding company's percentage of the what? Post acquisition reserve, which is 90 naira, is what? 81. That accounts for the balance in the reserve account here, using your double entry what? Approach. At the end of the day, the balances goes to the respective what? Ledger. So another interest here, we have 20. It gave us a goodwill of 101. Reserve increased from 150 to that's holding company reserve, which is what we call the consolidated what? Profit and loss, or consolidated reserve, increased from 150 to what? 212 by virtue of the post-acquisition what? Reserve of 81 naira. So this is the what? Position of the consolidated balance sheet. The assets is now 200 for subsidiary, 250 for what? Holding company, which is 450. Goodwill from our what? Acquisition, which is 101. So we have 551. Then we have the reserve, which has increased from 150 to what? 231 by virtue of the what? Post-acquisition reserve, which is what? 231. And then we have share capital here, holding company perspective, 300. The minority interest is what? 20 naira. So when you add, you have 551. So this is, a simple approach to using double entry to what? Record group balance sheet while taking into consideration post-acquisition, or let's say pre-acquisition and post-acquisition with reserve. So if you have questions, you can reach me in the numbers displayed. I'm going to reply with the right answer. So let's look at what we call the consolidated schedule, of course, as in practice these days. Okay, like I said, it's still double entry, but we're showing it in what, in a vertical form or in a form of schedule. Okay, so we look at how to use the consolidated schedule. Of course, if you have questions, you can reach me on the numbers displayed. Okay, let's look at this very straightforward question to understand what, or have an idea of what we're talking about here. So we have the following represent the balance sheet of Kings Limited and Queen Limited at 2018. So we have assets for Kings, we have assets for Queens there, land and building, furniture, debtors, investment in Queens, 130, cash and bank. Then we have liabilities, share capital, reserve. Then we now have additional information. Kings Limited acquired 90% of shares in Queens Limited on 2016. You can see that date of acquisition is 2016. Then balance sheet is 2018. When its reserve was 1,150,000, so that means there's a pre-acquisition reserve. So you're required to prepare consolidated consolidation schedule, consolidated schedule, and consolidated statement of financial position at 2018. So what we're saying here is that we have to prepare the consolidation or consolidated schedule, and then prepare the consolidated statement of financial position at 2018. Okay, so let's quickly look at this. So let's say right. So we're going to have what we're going to have here now is costs of control, which will be K in Q, because that's 90%. You have minority interests, which is 10%, and we have, let's do this way, you have consolidated P and what L. Okay. So let's a marker here. I hope it does not disappoint us. So what do we have now? We have share capital. Coins. How much is the coins? Share capital 100,000. So we have it as 100,000 naira. So this is 90%. That would be 90,000 naira. Of course, notice it's in 000. Let's not forget that there. So here will be what? 10,000 naira. So we add up the after. So we have the reserve now for coins. What's the reserve there? 21,150,000. Okay, that's 21,150. But we're going to have to look at the pre and the post. So here, what do we have now? We have 21,150. Pre, according to the question, you say is 1,150. That's asset acquisition, 1,150. So post will be 21, that will be 20,000. Right? Good. So we're there now. So, but then minority interest first will take its share. Share of 21,150. What's minority? That's 21,150. What do we have there? That's 0.1 times 21,150. 2,115. We have 2,115. Now for the consolidated what? P and L to be what? The holding company's percentage of the posts, which is 20. So holding company is what? 90% of 20,000 is what will come here. So let's say times 0.9. Since 90% is the what? Control. So we have 0.9 times 20,000. 18,000. So put 18,000 here. This will be 18,000. So for the pre, it will be the what? 90% of the 150. 0.9. So we'll say 0.9 times 150. 1035. So we have 1035. So if you add up everything, it should give us 21,150. So we'll say this 1035 plus 18,000 plus 2115. So we have 21,150. So if you add up everything here, it will give you 21,150. So that's it for the cost of control, minority interest, and the consolidated reserve. So then the next thing is what now? We add up. So we get the what? Net asset acquired. So for here we have 53019 91035. Here is 12115. Okay. So this will be the net asset acquired, right? So we now say investment. This is net asset. Investment is what? Investment in Queen is what? Investment in Queen is 130,000. So we have 130,000. So take that out. So what do you, this will be your goodwill on what? Consolidation. So what do you have? 130,000 minus, what do you have there? 91,035. 91,035. 38965. You have that as 38965. So if you test this, you will see that it's what? It's a debit balance goodwill. Okay? So this is your goodwill. Then this guy here with 12,115. Then you now have what? Your King's what? Reserve. What's your King's reserve in the question? King's reserve is 104,500. So we have 104,500. So when you add up 104,500 plus 18,000, what do you have? 104,500 plus 18,000. 122,500. So we have 122,500. So this is what you're taking towards consolidated balance sheet. Okay, so let's prepare the consolidated balance sheet there. So we'll say Kings and its subsidiary. We'll say Kings, and marker here, it's not performing. Kings and its subsidiaries. So that will be balance sheet, or can say statement of as at 31st December 2018. Okay. So we have assets. So what are they? So let's call this notes. Note 1 now. So we have note 1. So let's call this non-current. What are the non-current there? Non-current asset there, what are they? We have land and building, furniture and fittings. So land and building. What do you have? 80,000 plus 52. So what do we have there? We have 132,000. 80 plus 52. Then the next one, furniture and fittings. What do you have there? 40, 25, 500. So what do you have? What's plus 25, 500? 40,000, 500. 65, 500. We have 65, 500. So when you add up, what do you have? 500 plus 132,000. 197,500. So we have 197,500. So what's the current? Current, that would be note 2. Note 2, what are they? Debtors and cash at bank. What's the debtors there? 20,000 plus 15,000. That was 35,000. Bank. What's our bank there? 34,500 plus 28,650. 34,500 plus 28,650. So what do you have? 34,500 plus 28,650. 63,150. 63,150. So when you add up, what do you have? 35,000 plus 63,150. That's 98,150. We have 98,150. So when you add up, what's your total assets? 98,150. 98,150 plus 197,500. What do I have? 2,956. All about goodwill. Let's not forget our goodwill. Let's not forget our goodwill. So we have good. What's our goodwill here? 38965. 38965. So say 98,150 plus 197 plus what? 38965. 38965. 334615. 334615. So let's go now. Our liabilities now. What's our reserve? We 122 500. 122 500. Okay. What's the share capital? What's our share capital? 200,000. Then what else? Minority interest. What do we have there? 12,115. 12,115. So we add up. What do you have? 122,500 plus 200,000 plus 12,115. 334,615. So this is your total liabilities. This is your total assets. So what we've been able to do here is to use, the consolidated schedule approach to prepare the consolidated balance sheet or group balance sheet, where there is the difference between the date of acquisition and the date of consolidation. That means there is pre and post acquisition reserve. We're able to identify that before the acquisition there was a reserve of 1,150. Reserve as at the balance sheet date is 21,150. So when you find the difference, 20,000 is the post here. The holding company takes its share of 90%. That is what you have here. 1,150 here is the pre. Holding company takes its percentage. This is 1,035. The total reserve, minority interest has been there, so it takes its full percentage, which is 10%. Okay, 10% of this. That will give us 250. The share capital is 90%, 10%. You can see that this is the net asset acquired. When you compare to your investment, you have a goodwill. Test this investment. You have a debit balance goodwill. You have an asset here. I already taught you how to test for it, so you can check your previous classes. So we're going to get this. And then we got that there was a goodwill of this minority interest balance. And this is the working reserve. Of course, the post-acquisition reserve increased the holding company reserve from 10500 to 122,500 by adding 18,000 to it. That's how we're going to get it. So with that, we're going to prepare balance sheet, which is what the group balance sheet. The non-current asset here, land and building and furniture, which is the land and building of the holding company and the subsidiary. Furniture of the holding company and the subsidiary, I get 197,500. Current asset here, we have the debtors of the subsidiary and debtors of the holding company. Bank balance of the subsidiary and bank balance of the what? Holding company. That gives us this. Then the goodwill that will go from the schedule, that's 8965. Total is 334,615. So we have 197,500 non-current, 98,150 current, goodwill 38,965. Give you 334,615. Liabilities there, our reserve is 122,500 from here. Share capital is 200,000. Of course, you can get that from the question. Minority interest balance here is 12,115. So that gives us 334,615 as total balance. Okay? So if you have questions, you can reach me the numbers displayed. I'll bet you reply the right answer. Don't forget, you can support us by paying the account number displayed, or sponsor copies of my textbook for free distribution to students. That's how you can support us. Thank you. See you next class.